Stop, listen. Because the money printer didn't restart in a meme, it restarted on a calendar. December 12. While most people were arguing about charts and politics, the Federal Reserve quietly set the machine back to buy. Not QE, at least that's the label. But the action? The same direction. The Fed starts purchasing Treasury bills to rebuild reserves and manage liquidity. And if you don't understand why that matters, here's the short version. When the Fed is buying again, cash doesn't suddenly become safe. Cash becomes a melting ice cube. 3 clues. Same week. Same story. Clue 1. The Fed cut rates by a quarter point to a target range around 3.5%, 3.75%. Reuters. Clue 2. The Fed halted its balance sheet runoff QT, effective the 1st of December 2025, as money market strain concerns grew. Clue 3. And then the big one. Reserve management purchases of short-dated Treasury bills began on December 12, with an initial phase around $40B. That's not one isolated move. That's posture. That's the Fed saying, we are not going to let liquidity get too tight. The word game. The Fed knows what you think when you hear buying. So they do what they always do. Rename the thing so the public doesn't notice the direction. They call it technical. They call it reserve management. They call it operations. But markets don't trade labels. Markets trade flows. Reuters reported Powell framed the purchases as solely to maintain an ample supply of reserves and support control of the policy rate, separate from the stance of monetary policy. Okay, fine. But reality is simple. If the Fed buys bills, the Fed injects reserves. And reserves are the oxygen of modern finance. This isn't conspiracy, it's published policy. The Fed's implementation note on December 10 included increasing SOMA holdings through purchases of Treasury bills and, if needed, other short Treasuries to maintain ample reserves, rolling over Treasury principal, and reinvesting agency principal into Treasury bills. Then the New York Fed laid out operational details. From December 12 to January 14, the desk planned roughly $14, $4B in reinvestment purchases, plus roughly $40B in reserve management purchases over that monthly period. So when your feed says Fed money printing starts deck 12, you now know what they're pointing at. Buying really did restart. What money printer really means. The Fed doesn't need to wheel out pallets of cash. Printing in a modern system is balance sheet mechanics. When the Fed buys a Treasury bill in the secondary market, it pays by crediting reserve balances. That's base money creation inside the banking system. And you can see the ecosystem in the H.4.1 balance sheet. In the December 11 release, week ended December 10, total assets were about $6, 539 tons, and reserve balances were around $2 and 932 tons. So the printer is not poetry. It's an accounting entry that changes liquidity conditions, how the printer moves. Step 1. A primary dealer sells a Treasury bill in the market. Step 2. The Fed buys it. Step 3. Payment doesn't arrive as a suitcase of money. It arrives as a credit to reserve balances, digital base money inside the banking system. Step 4. More reserves equals easier funding conditions equals less chance the plumbing seizes. That's why the Fed keeps insisting this is technical. They want you focused on the story, not the physics. And here's a detail Reuters put right in the open. This comes after years of QT that shrank the Fed's balance sheet from around $9 tons to about $6, 6 tons. So even though we're nowhere near 2020 style QE, the direction has flipped from shrink to expand. Why the label matters, even if it's still buying. The Fed will fight the QE comparison because QE is political. QE sounds like stimulus. QE sounds like we're bailing out markets. Reserve management purchases are framed as plumbing. Keep reserves ample. Keep money markets stable. Keep the policy rate under control. But Barron's and the FT both made the uncomfortable point. Even if the intent is technical, the effects can bleed into markets supporting liquidity and blurring the line between operations and accommodation. So in real life, the public hears not QE. Markets hear a steady buyer is back. The numbers that should make you sit up. The first phase wasn't tiny. Reuters reported the initial round was around $40B. Then Reuters reported the New York Fed's desk schedule showed more than $54 in total transactions between DEX 12 and Jan 14, combining reinvestments and reserve management purchases. $40, $54 is not hyperinflation fuel by itself, but it is a flare that says liquidity had to be topped up. And once the world accepts topping up is necessary, the debate shifts from will they ever buy again to how long until they buy more. Why did they do this now? Because something was starting to creak. The Financial Times reported the Fed launched this $40 bill buying program after money market strains and volatility linked to prior tightening and runoff, with repo market rates showing signs of dislocation. Reuters described it as a move to manage liquidity and keep firm control over the policy rate. Translation: they saw the system getting tight enough that the Fed's control could slip. So they moved